Good morning, students. I welcome you for the online class of business studies. Today economics. Today we will be going to complete the topic that is the balance of payment. Also, in the topic in the chapter one, the next topic which we will be going to continue is the capital account. Capital account, student, when we will be going to learn capital account is that account in which fixed assets related data are entered or the ownership of assets details are mentioned. Capital account is that account which records all such transactions between residents of a country and rest of the world which causes a change in ownership of assets. Okay. Unlike the current account, the capital account transaction do not involve the movement of goods and services between one country and rest of the world. Capital account transactions should not be misunderstood as those transactions which relate to the export and import of capital goods like plant and machinery. All such goods which cross the borders, whether they are consumer goods like milk for the babies or capital goods like plant and machinery, are recorded as merchandise are included in the current account balance of payment. Capital account balance of payment transactions mainly relate to physical assets like land and building as well as plant and machinery which remain within the domestic economy but the ownership of which changes on account of their international sale and purchase. Financial assets like stock and bonds, the ownership of which changes when they are purchased by one country from the other and international claims arising out of the loans and borrowings. That is a capital account, student, as we will be what we have learned. Capital account transactions do not involve the movement of goods and services between one country and rest of the world. Okay, so that like the current account, capital account, it does not involve the movement of goods and services from one country to rest of the world. Capital account transaction should not be misunderstood as those transactions which relate to export and import of capital goods like plant and machinery. So yes, definitely the transaction which is passed, it must be not have any confusions or bias, because it is the export and import transactions which once made, it cannot be revoked. All such goods which cross the borders, whether these are consumer goods like milk for the babies or capital goods like plant and machinery, etc., are recorded as merchandise and included in current account balance of payment. Capital account balance of payment transaction mainly relate to what things? Land and buildings, that is physical asset, which remain within the domestic economy. It cannot be transferred from one country to another, but the ownership of which changes on account of the international sale and purchase. Yes, definitely, any foreigner had purchased the land and building of our country. The land and building cannot be moved to that foreign country, for a country, but it can, the ownership of the land and building can be changed. Financial assets like stocks and bonds, the ownership of which changes when these are purchased by one country from the another, and international claims arising out of loans and borrowings are considered as capital account. Important thing, sale and purchase of all goods, consumer goods or capital goods is recorded only in the current account balance of payment. Thus, import or export of machinery, which is a capital good, will be reflected in the current account as an element of merchandise. Capital account records only such transactions which relate to flow of capital foreign exchange between the countries on account of change or in the ownership of assets, physical assets or financial assets, or on account of loans and borrowings. We can thus say that whereas current account shows balance of payment shows nation's net income, balance of nation's net income arising out of net export and import of goods and services, whereas capital account balance of payment shows the net change in the country's ownership of assets in relation to rest of the world. Here the ownership is changed from one country to another of the goods and services. As here it is important to note that the financial claims arising out of the loans to rest of the world can always be used for the purchase of assets, physical assets or financial assets in the rest of the world. Let us elaborate on the components of capital account balance of payment in detail. Borrowings and investment. Expenditure on the ownership of assets abroad are the two principal components of capital account balance of payment. Borrowings is often split as external commercial borrowings and external assistance. The principal difference between the two is that while external commercial borrowings ECB is available at the market rate of interest, external assistance is available at the concessional rate of interest. More investment is classified as portfolio investment, FD, foreign direct investment, etc. Portfolio investment basically refers to foreign institutional investment, which is investment by the non-resident in shares and bonds of the domestic company. Foreign direct investment relate to ownership of enterprises by the non-residents in the domestic economy, like Walmart stores in India. Foreign direct investment is considered to be more stable form of investment than foreign investments. International investments. NRI deposits is another important component of capital account, particularly in the context of emerging economies like India, where interest rates are high. The capital account also includes banking capital. It refers to foreign assets holding of the commercial bank. What we have learned from this particular reading of the paragraph, that very first point which we have read was that, like current account balance of payment, which shows nation's net income arising of net exports of goods and services, capital account balance of payment shows the change in the country's ownership of assets in relation to rest of the world. It is important to note that the financial claim arising out of loans to rest of the world can always be used for the purchase of assets, physical assets or financial assets in rest of the world. So that is the point about the capital account transaction, because it is with the physical assets. Okay. Now we have read that particular paragraph in the down, that capital account balance of payment, how it is in details. Borrowings and investment. Borrowings means when we are taking money from someone. Investment means when we are expending on the ownership of asset abroad. It is known as investment. Are the two principal components of capital account. Okay. Asset and liability. Asset, investment will be there. Borrowings, liability will be there. Borrowing is often split as external commercial borrowings and external assistance. Okay, it is further split into two parts. That is, one is external commercial borrowing and second is external assistance. The principal difference between the two is that while external commercial borrowing is available at the market rate of interest, external assistance is available at the concessional rate of interest. Investment is classified as portfolio investment and foreign direct investment. Portfolio investment, what is divided, concessional rate of interest investment is classified into two, portfolio investment and FDI. Borrowings is divided into two, external commercial borrowings and external assistance. Same way foreign investment is also classified into two, portfolio investment and second is foreign direct investment. Portfolio investment is generally what? That is foreign institutional investment. Okay. What is portfolio investment? It is foreign institutional investment. If a country invests in the foreign countries, institutions or organized land and buildings, it is known as portfolio investment, which is investment by the non-resident in shares and bonds of the domestic companies. Like if foreigners are interested in any of the land and building of our country, they are investing in that in our country, domestic, that is domestic companies, they are investing. That is known as portfolio investment. So portfolio investment includes both the things, that is FFI, foreign institutional investments. FDI relates to, what is the second? Portfolio investment we have understood. Now the next is FDI, foreign direct investment. It relates to ownership of enterprises that by the non-residents in the domestic economy, like Walmart stores in India. A foreign direct investment is considered to be the more stable form of investment than foreign institutional investment. Okay. The non-residents of India deposits, is NRI deposits, another important component of capital account. If any NRI is investing in our country as capital account, particularly in the context of emerging economies like India, where interest rates are very high. The capital account also includes banking capital. What else things we have learned? There are these things where portfolio invest, FDI. So here external assistance and the external commercial borrowing is included. Now we will be seeing what all things are there. FII is also FFI, as I said, FII also is included there as portfolio investment. What all things are extra added? NRI deposit is another important component of capital account, particularly in the context of emerging economies like India. So here more things will be coming there, which is deposit, that is NRI deposit is also coming in capital account. Capital account also includes the banking capital. Okay, so these all things are included in constituting the form of capital account. It refers to what is banking capital. It refers to foreign assets holding of the commercial banks. All the commercial bank which is existing in our country, doing business in our country, if they are having the foreign assets paper, if they are keeping that it will be coming in capital account. Owing to drawdown of foreign assets of the commercial banks, inflow of foreign exchange into the domestic economy tends to rise. Finally, the capital account balance of payment include flow of capital on account of short-term debts, short-term trade credits. With this information in mind, we can now present a format in structure of capital account balance of payment as under. Structure components of capital account balance of payment are as follows. Very first, indicating net capital flows, foreign investment, borrowings. Okay, as I already said, capital account structure, it will be more easier when we will learn through the help of flow charts. Okay, so flow chart, what it is saying, structure components of capital account balance of payment, it is bifurcated into two. One is foreign investment, second is borrowings. We have learned in the above paragraph. Foreign investment include two things, that is FDI, that is portfolio FDI, foreign direct investment, and one is FFI, that is foreign institutional investment. The FFI is also considered as portfolio investment. Okay, borrowings, external assistance, second external commercial borrowings, and sorry. Besides that, capital account includes other things. Besides the foreign investment and borrowings, capital account includes NRI deposits, banking capital, commercial bank holding the assets of the foreign countries, important asset, then it will be considered as banking capital, short-term trade credits, other flows. This all included in the capital account. So this is the parts of capital account. So it is, may I think, clear from this flowchart what we have learnt in the above paragraph and what all things are included in the capital account. Now let us proceed to the other topics. Note, similar to current account, capital account records all payment to rest of the world has debit indicated by the minus sign, and all received from rest of the world has credit indicated by the plus sign. Net receipts refer to the difference between receipt and payment. Net capital flow, that in the capital account, shows the balance on account of capital account transaction, which may be positive or negative. Positive balance indicate that inward flow of foreign exchange. Okay, means more of the foreign currency is inflowing in our country, then definitely it will show positive balance. But negative balance also can come when our country's imports are more and we are investing in the foreign countries. Definitely our foreign currency will be declining and their currency will be increasing. So that situation, negative imbalance, indicates just the opposite. So okay, next is illustration. One more illustration for today's class also. Estimation of capital account balance based on actual data, April-September 2012 economic survey 2012 and 13. Items US million dollar, you can see. External assistance borrowings is there. External commercial borrowing, that is also borrowings. Okay. Short term debts, that is other flows, other transactions of the capital account. Banking capital, that is this also we have learned that it is included in the capital account. Foreign investment, net, foreign institutional investment, other flows, capital account balance. Okay, how to solve? It shows that during the period April-September 2012, there has been a net inflow of foreign exchange of rupees of US dollar 39,989 on account of capital account balance of payment transactions. Overall balance in the Indian balance of payment accounting system, overall balance is estimated as the sum total of current account balance, capital account balance, and errors and omissions. Okay, so overall balance we have to take out. Overall balance formula we have learned that it includes current account balance plus capital account balance plus errors and omissions. Let us see there whatever things this sorry. If this formula is clear, that is overall balance, you can take out current account balance and capital account balance is given there. As errors and omissions are not there. The net inflow is already calculated and given. So capital account balance is given, errors and omissions are not there. Current account balance is also not there. So it is the total what we have gained. 39,989 is itself is the total current total balance, overall balance. Next, estimation of overall balance based on actual data for the period April-September 2012, Economic Survey 2012 and 13. The overall balance, current account balance plus capital account balance plus errors and omission, the same formula is here. Let us see what is the data. Illustration 3 is telling there. Here overall balance, same question is there, 39,989 is there. Other flows, net 4770 is there. Short term debt is there. So let us see what has been said. How much? It is 39,989. But how much it is showing there? 38,973 it is showing there. Okay. Here the question is half not came. So here according to the errors and omission, how much error and omission is there? 653. How much if we will be errors and omission, we will deduct. Current account balance is given 38,973. And capital account balance is already we have seen 39,889. Errors and omission, how much is given in the question is not given here, but errors and omission is there 653. If we will deduct all those things, we will be getting the capital overall balance. Okay. Next class we will be going to learn official reserve account and other topics of the chapter. Thank you for today's class. Have a nice day.